in that company. Or again, maybe if you are looking for a job, you also say, okay, the finances are not looking good. Do I want to be an employee of that company? Because things are actually not looking well. So then they say, when we say a transaction is where money is paid either in return for an item or service, so where the buyer needs or is obtained. So if you either you need to buy an item, then you say, okay, I'm buying a piece of clothing. That's okay, that is a transaction. Then we'll throw to say, how do we actually record that as time goes on? Sometimes it can be a service. A service, for example, you say, okay, I need somebody to clean for me. That's actually the service where somebody comes. You can only have a look to say, okay, this is the outcome, but it's not like a piece of clothing where you say, okay, here I can physically touch that item of clothing. So that's how financial accounting just goes to see with these activities, how do we go about identifying what needs to be recorded? How is it going to be recorded? And actually to see whatever happens with that thing, how do we actually present it to all the relevant stakeholders? So these are the objectives of financial accounting. So it's basically to ascertain to enable the users with that information which we present to say what is the financial results and financial position of the entity. So the financial results mainly we are reporting to say, did the company make a profit or loss in a year? And then basically with that, you can say, okay, this is where we say we bought goods for how long, much, we sold them for how much. These are our expenses for the year. Maybe we paid rent, we paid salaries, but in the end, did we make a profit or loss for the year? The financial position of it is actually where we say, taking into account also there's going to be an element of that profit or loss. Overall, do we still have money as a business? So do we have assets where we say, for example, we've got your buildings, your cash, and with that to say, how many people do we owe? And basically, do you have net equity? To say, sometimes you'll say, okay, you can have assets of 5,000, but if your liabilities, for example, are 7,000, so you actually owe people more than you actually have. That's where to say your financial position is not negative, it's negative, and then we'll say, okay, you're actually trading insolvent when we refer to say in accounting terms. We will also just look to see what's the whole income. Those will be your revenue, whether you sell. So if you're renting, it would be your rental income. And you look at the expenses which you incurred in producing that revenue. So if maybe you're selling a piece of clothing, you'll see you bought this stock, what's your cost of sales? And if maybe there's also employees which you employ, you also need to say, okay, I'm paying salaries. And if there's a building which you're actually renting, so that's where you'll see these are also some of my rental expenses. And how much does the entity owe to other entities? This is basically your liabilities. And then you'll have a look to say, it's either, for example, you took a loan to say, okay, how much do you owe as a loan? And maybe as a business, if you sell stock, you might find that some of that stock, you actually bought it on credit. So you actually need to record it to say, how much do I owe my suppliers? Maybe there's rent which you find you still haven't paid yet. It still needs to be also recorded in there. There's also elements sometimes where you'll say if as an employee, you'll say, okay, how much do I owe my employees? Maybe there's a provision in the employment of contract where you say if people leave, you can sell back your leave days. That's also because if a person effectively you owe those people the money of the leave days, so you also need to record that. On the customers, you also need to say, especially if you sell on credit, to say for example, you're talking about Jet, how many people have accounts and how many people actually owe us within this in the entity. So you actually need to record that to see okay, how much am I actually being owned as a business? And what the next one that we actually need to ascertain is what is the nature as well as the amount as for other maybe properties like assets you have. So you can either have as a business, say you invested in maybe shares as a business, you say, okay, we bought a stake in shares in another entity. Or for example, you say, okay, we own these buildings. This is the machinery we owned. You also need to attain the value to say, how much is this building, which I as a business have, and then you also record that in the books. And the amount of capital is basically saying this is the assets we have as a business, and then these are the liabilities, and this is basically the remaining amount. So this is the remaining balance to say this is the equity. So if we're saying today, taking into account, we take our business, we take our buildings, we sell everything, and then we pay all our creditors, everyone we owe. Basically, we dissolve the company. This is what actually will be left to the founders of the business. So that's actually like the shareholders' equity. So there's basically three activities which financial accounting mostly focuses on. So the main one is where we say we identify what actually the transaction is. So here we actually say, okay, if there's a transaction taking place, maybe you're selling an item of maybe a piece of clothing, to say when does that transaction, you say now has that transaction happened. So the moment you identify to say there's a customer who came in, took this piece of clothing, then bought it either cash or on credit, and then there's also an evidence to say, okay, it's either they paid for it cash or on account. It's evidence that there's an economic activity. And then you actually need to say, okay, I've identified this is a transaction which actually needs to be recorded. That's the first step. And the recording of it is actually, you say, okay, there's a sale, this took place, but actually, how much did the sale actually take place at? So you actually need to record the monetary value of that amount so that at least it gives a record as an entity to say, if come and year end, you will be able to ascertain to say, we've made sales of 5 million or we've made sales for 500. And the third activity, that's where mostly you will actually, because most of these other activities which are happening, the recording, the identification, they'll be happening in the backstage. That mostly especially for big businesses, you'll only find out when they actually communicate those results to the stakeholders. So the information actually is either you communicate it, that's where they say, okay, they provide the most common languages it to say they need to present it to the users. With an entity which is not listed, they do not have to disclose their financial information. So we'll just go into detail just to have a look and see how each of those statements look and what do they contain. But basically the statement of financial position. So this is what mostly you find. Previously it was actually referred to as a balance sheet, but it's one of those terms which you can still use interchangeably. So you'll hear a person saying, give me a balance sheet and an income statement. Income statement is basically the statement of profit and loss and other comprehensive income. So on the statement of financial position, that's where we'll say, okay, how is the financial position of a company at a specific date and time? And then we look at the statement of profit and loss. That's where we'll actually show our income and expenses on the profit and loss side. And then the other comprehensive income, you just maybe show if the company is involved in other activities, like maybe there's forex gain and stuff. And on the statement of changes in equity, it will actually show the owners to say you had equity of 500 at the beginning of the year, you paid dividends of 200, you made a loss of 200, actually now your equity position is basically around 100. So it's just a snapshot taking into account. It actually comes from the other statements. On the notes, there's also notes which needs to be presented. Here, there's actually, for especially like with a big company, if there's revenue, they need to say what do they mean when they say this is our revenue. So they will come and then there will be an accounting policy side where you say if it's revenue will mean goods sold to customers. And the notes is actually, sometimes when you look at the apps, they can just tell you revenue is 500, or maybe they put one item. So when you go to the notes, that's where they need to basically elaborate further to say, okay, this 500 is actually comprises of maybe sales to internal customers, sales to external customers, and the breakdown of it. So in the notes, that's where actually you get more detail, especially if you do not understand what's happening from the main page of the financial statements. So here's just a background, also just to give a brief description to see what's the difference between, because you'll hear accounting, then you'll hear there's also bookkeeping. So the stage, especially where the initial stage of recording is actually, that's where the bookkeeping is. So each and every transaction, so this is actually done in the background to make sure that each and everything we actually put it in writing. So all this information will be just recorded. And then I think in the next study areas, you'll see how we actually move, say after we get the transaction, either a cash or credit transaction, where we actually will just go through the process to say, okay, it moves from this account to actually see how it actually ends in the financial statements. So the ultimate goal of it all is just to make sure that we actually prepare the financial statement. Even though the financial statements are, for most companies, like you find they're prepared once a year, but actually this process is actually going on a daily basis in the form of bookkeeping. And then we make sure that we post the trial balance mostly on a monthly basis. So it's actually accumulating to say end of the year. This is how actually the figures are coming from. So financial accounting, it focuses functions like as an information system. So where we say these are the results which are reported in the financial statements. Basically, this is how our business transactions which we have taken are actually measured, and then to ensure that it's recorded appropriately. So the diagram on the right is actually just gives a input to say, on the input, this is where we've got the transactions data, and then we record based on the source document. And when we process that information, the first step is only just to start with a journal. And then so a journal is basically after you buy, if it's a sale, you're selling goods to say, okay, this person has bought an item, say for example for cash from my side, what do I debit, what do I credit, so that it actually appears correctly in the apps. So you'll say, okay, this person is buying for cash, my cash balance will increase. That's where you'll debit your cash, and then you'll credit your revenue. But we'll go into details to determine which item increases. So you need to find out which item increases on the left or on the debit side of the journal. Post that after all the journals are done, you actually post that information to the general ledger. The general ledger is basically to say, this is the revenue general ledger. These are all the items which were posted to revenue for the month. And we have the general ledger. And from there on, we'll actually just say, okay, it's taking it back to the trial balance, where you say at a specific time, this is how the trial balance looks. So the trial balance must always balance. So with accounting, that's why we say whatever you do on the left, you must also do on the right. With a T balance, if you debit something, there needs to be something which needs to be credited. So each and every transaction you do, it must always balance. And then from that trial balance. After you have the trial balance, this is where you actually go and prepare the financial statement. So this will be your statement of financial position, statement of comprehensive income, your cash flows, and there will be like an analysis and interpretation which is done where if you find sometimes, especially when you hear with big companies, there will be analysts analyzing those financial statements to see company X, Y, and Z did well or didn't do well. This is how the market is treating it. That's basically where they come in. Because if you look at the first stage, the input, the processing, this is all internal. It's not in the public news. This part, the preparation, the financial statements, if the company, that's when it gets out to the public. And from there on, the analysis and interpretation will take into account to see what happened during the year. Is there anything which we think it was supposed to be here or we expect how the company is not doing well? And this is the part where they actually, as a company again, they will say decision making. Either say for companies, they say, okay, we're expanding or we feel like we're not doing well, we'll need to retrench. It also affects that decision making part of it. So accounting basically it's governed by especially the preparation with the International Financial Reporting Standards. So International Financial Reporting Standards is basically a set of rules actually which states like how a company, especially because with a public company, you have to follow these rules to make sure that the transactions basically are consistent. Because with big companies, if say, for example, we say I'm comparing two companies, if they are prepared differently, one will appear as if it's doing well compared to the others, while it's actually is how that information is recorded. So the main aim for IFRS is just to make sure, International Financial Reporting Standards, so mostly you'll hear, especially with accountants, will actually refer to it as IFRS, just the acronym for it. It's just to make sure that this information is consistent. So taking into account that we need to compare, because when you prepare financial statements, you actually need to prepare cooperatives. You need to prepare for today, and then you put another column for last year. So you need to compare to say in June 2020, this is how it looks, but in June 2021, so this is how it is. So it needs to be comparable. So if you actually not following the same rules, you will have 500 for year one and 500 for year two and 600 for year two. But when you check to see, it actually depends on how that 500 or 600 was recorded. And for transparency, you just need to make sure that whatever information is there, it's easier for people to actually understand and read through to say, if you say it's revenue, people need to know what your revenue consists of. If you are a company selling groceries, they will need to know, okay, this revenue is from the sale of groceries, and to make sure that it's easily comparable. So if I take a company selling groceries in South Africa and compared to another company selling groceries in Mozambique, I expect them to follow, because the International Financial Reporting Standards actually followed done across the most of the countries in the world. It's just that we've got few countries like US where they've got their US GAAP, but it's actually just a slight tweak in there from IFRS. Just need to make sure that they are also comparable. And so it actually governs the types of transactions and events which should be reported. So before you can actually say this is my asset, IFRS will actually define an asset for you. If your definition of an asset does not mean, because with an asset it says it's a resource controlled by an entity for which future economic benefits are expected to incur, to happen to the entity. If you find that you fail to comply with that definition, then you can't record it as an asset. So it does goes to say, for comparison purposes, you can't say, no, my assets are 500, company B says their assets are 200, because you first put 400 because you actually just added something which IFRS doesn't believe is an asset. So IFRS standards are actually developed and maintained by the International Accounting Standard Board, which is an international entity. So it actually gives rules. So you need to comply with it. The moment when you prepare financial statements, if you can have a look, the first few pages, they actually write to say, before if you as in before you get the Fs, you actually need to check, is this they are prepared in accordance with IFRS. So if you're looking for example, in South Africa, it will be like a small entity. There's also IFRS for SMEs, where they will actually go there. It's basically IFRS, but because IFRS is too broad and a bit complicated, there's some items where they'll say, for as a small company, this is something which is sort of compromised, then you can actually use those. So you have to check, okay, is this in accordance with IFRS, or is this in accordance with IFRS for SMEs? Or if it's maybe a US company, you'll see it will say compiled in accordance with US GAAP. So in South Africa, basically, there's a Financial Reporting Standards Council, which actually just goes and sort of acts to say, okay, these are the standards which South African companies need to look for. So it's actually just standardizing, which provides to say companies need to keep record. How are they actually supposed to record their transactions? So the objective of financial statements, the main aim is to provide information, so which is actually true and also needs to be fair, to provide a fair view, basically about the financial position, how's the company standing, the performance, which is actually how did the company do during a specific period. So with the statement of financial position, it will be like, if we say as of 30 June, it's actually showing, if it's cash, it actually shows the cash balance which was in their account as of 30 June. So whatever is information is in the financial position is at a specific date. And with the performance, they will actually, if you have a look at the top, it will say either for the 6 months ended or for the year ended. That's where it tells you it's actually cumulative. If it's for the year ended, it's revenue for the whole year. If it's for the 6 months ended, it's actually revenue for the 6 months. It's different compared to a cash flow, to a statement of financial position. And a cash flow is actually also provided, where it actually gives information of how the cash was used. So the cash flow, as you can know, people will mostly say in a business, cash is king. This is where you actually need to have a look to say a company can be making profit, to say, no, we've got 2 million profit, but when you check their cash flows, you actually just say, okay, it's actually operating on bank overdraft. It's not making any cash. That's also a trigger, which people will actually say, here I need to take a step back. I actually need to look, especially if maybe you are invested in that company, or maybe if they owe you money, to say, okay, do I need to call my money back now or something? And you need to make sure that financial statements which are presented are understandable. So any person, if you give me a set of financial statements today, I need to be able to understand how did they do, what's their financial position, what do they mean with this item. And with financial statements, we must show, okay, how is their debt? Do they owing a lot of people money? Is a lot of people owing their money? And also just to show, is it relevant for the business entity you're dealing with? You don't want to deal with an entity, say you take financial statements, say for a company that's involved, maybe say for example in renting properties. But when you look at those, at the financial statements, you don't see anything talking about rental income or the expenses relating to servicing the buildings. And also just need to make sure that it's comparable. So comparable to its own and compared to previous years, and comparable again to the peers. So the main objective of financial statements also just to make sure is for basis for decision making for stakeholders. Stakeholders refers to either the the owners of the business, because when you look at the big business, you have owners, they actually not involved in the business. So they're going to go and hire management who will actually run the business on their behalf. So they actually need to make sure that by looking at the financials, those management is actually hired, are they actually doing what they need to do? Also, the other stakeholders, mostly you'll find to say people who are actually the banks, if the bank gave you a loan, again, as an employee, you're also a stakeholder. Also, again, we're talking about even your SARS. They will also just need to make sure to say company ABC, every time when it submits their tax return, is actually making losses from a tax position. But when you look at their finance or their Fs, which is published to the public, there's always a lot of money which is actually making profit. So that's where it will also come in to say, how is it actually doing? And also just to report the effectiveness and efficiency of management. So this is just for those owners, that's to say, okay, how are those management we've hired to make sure that they run this business for us is actually run smoothly. And also just to increase the understandability of the end users. So for the end users to understand what's actually happening. So I think this is just the breakdown of just to show in detail to see who are the users of financial information. So for a client, it's mainly just to assess to say, okay, how is this the ability of a company to continue as a going concern? So basically, when we look at Fs which are actually prepared according to IFRS, if you look at the auditors, the first thing auditors needs to do is to say they are satisfied based on their understanding that the company is able to continue as a going concern. So what the Act requires is for a company to indicate if it will be able to say for a going concern, mostly we assess for the next 12 months. If we have a look at the Fs and then the audit report, the first thing, if the auditors don't believe that it's a going concern, it means the auditors are not sure this company will still exist, say 12 months from now. So as a client, when you take a look at those Fs, that's what we'll say, okay, there's reasons to believe this company is still going concern as for the next 12 months. So for employees, I think it also happens when, as an employee, before you apply for a job, especially if it's a listed entity or the moment you get an offer, you can request to have a look at the financials. Then you'll see, okay, am I maybe leaving my job for something which is worse? And also, again, this is where the unions actually will have a look to say, no, we want 5% increase, but you're saying you can only afford 2%, but the Fs indicate otherwise. So it's also just forms the basis again to say, how is the remuneration structured? For government, it also goes to say if there's maybe, for example, a company which like is involved in other it needs to comply, maybe pay fines or maybe pay royalties. Say it's a company maybe in mining, there's a Department of Mineral Resources will say, we need to pay 5% of your revenue basically as royalties. They will actually have a look at those Fs to see your Fs for the year. It's revenue of 500, but when you disclose to us, you only disclose 200 because there's still revenues to be paid. Same applies to tax, as mentioned before. They will need to say, okay, you made profit, but when it comes to us, you've never paid us any taxes. That's where they will come and reassess. For investors, it's actually just to check how is the risk, the investment, the return on their investment. If you invested money in company A, you actually want to see how the company is doing. You will actually, maybe if you bought shares, like either in a company that's involved in BE schemes like your Vodacom or your MTN, you will have a look to see. You will hear from there on to say, oh, okay, are they paying any dividends or the company is doing well? So if I sell my shares now, will I get a gain or will I be losing? For lenders, it's mainly just to check especially if for a bank, if they give you money, they will have a look to say, are you able to pay, or maybe even if before they give you a new one, are you able to pay the interest as well as the capital repayments for the loans? So the apps will actually just show there to say, okay, this company is not maybe generating enough cash flows that will be able to pay its loans. And also for suppliers, they will assess to see if before they give you further funding, are you able to pay the amount owed to them? Are you able to pay all your creditors, or every time it will be a request for restructuring? And for management, it's actually where they will determine, say, the planning, where's the company going. Sometimes it will also say, okay, now we're doing well. Do we need to expand? Do we need to downscale? And also what other things can happen? Because everything, mostly, even if they downscale or they extend, they actually need to check to see, does the financial position like allows for it? So I think it's just on the elements of financial statements. So I'm not sure if there's anyone who wants to ask a question, or we can just continue for now. Okay, I think we'll just continue. Then if there's any question, you can just maybe just pop it on the chat as well, and then I will just also just come across it later on. So for the elements of financial statements, basically it's those financial statements which we actually talked about. So the main one, so the first one, mostly when you start with looking at the financial statements, either you'll see first the statement of comprehensive income or the statement of financial position. So mostly you'll hear mostly like, because the thing is with the statement of financial position, when the names were changed by IFRS, it's still allowed to say you can still use the old names. So you find most people, especially who were involved, familiar with the way they say, okay, I still need the income statement and the balance sheet. So the statement of financial position, that's basically your balance sheet. It shows the information, basically how your assets, and then what is your liabilities, and also what's the capital owed to the business. We'll just show further slides. We'll just show again, I'll just present to you actually just to show you how each actually looks like. So it gives an overview of the company's assets or liabilities, like at a specific point in time. So with assets, you'll find to say, if you say you've got property, plant and equipment, or cash at a specific date, it will say, okay, as of 30 June, this is how much basically, if you're selling items on credit, this is how much your debtors were owing you. And with liabilities, you need to put that as a specific time to say, okay, as of 30 June, this is how much actually you're owing all your creditors. So when you look, it will actually just tells you statement of financial position. It will tell you at the top there to say what is the date which actually is. If it's for period 30 June, just know to say if it's cash, that was the cash it had as of 30 June. If it's your property, plant and equipment, so it actually just shows you to say this is how much of the property, plant and equipment the company had. So like with cash, as long as a specific point in time, we just put, but with the preparation, if the auditors, mostly they will do an audit to say, okay, it had cash of 5 million. If they find out, say, on the 1st of July, all the cash went out, then because they do the audit afterwards, they will come and put subsequent events. This is where they believe that, you know what, this position actually changed too much compared to the period which is reported, which is 30 June to currently now. So if you have a look to say, they mostly say there's nothing which they feel it can affect the position, because they need to also state to say this is a going concern for the next 12 months. So it also makes it easy for the business owners to say, okay, this is the assets we have, this is the liabilities we have, and then also this is the capital needed, because as an owner, they might actually be required to put further cash into the business. So where you actually say you need to increase your owner's equity. So it also just when you see, okay, the business is not doing well, and then that is where we'll say, okay, owners, shareholders actually need to inject some capital. So it's gonna give them an indication to say there's an injection of capital which is actually needed in the business. So the main item, as mentioned, it will be your assets, your liabilities, as well as your equity. So with your assets, basically what we do, actually, you need to split to say which are your current assets and which ones are your non-current assets. So with your current assets, this is where you say, you put in your actually assets which you are able to realize within the next 12 months. So it will be your cash, or if maybe there's people who owe you money, where the terms actually they're supposed to pay you back within the next 12 months. And with your non-current assets, you'll be saying, like, if you've got the building, to say, okay, this is non-current, or if maybe you gave a person a loan, say, for example, a bank gave you a loan to say, you'll pay this loan over 5 years. The portion which is not payable next year will actually be put under non-current assets. And same applies to liabilities. There's got current liabilities as well as non-current liabilities. And with equities, that's where actually you show to say, this is your owner shareholders equity. This is how much the shareholders have put in the business. This is how much profit or loss basically the company has made over the years. So it actually will have a company as part where you say, the moment you've got your profit and loss, and then if you decide to declare dividends, whatever is remaining, you put it as retained earnings, and then that's you say, okay, goes back into the business to basically grow the business. The statement of comprehensive income. So this is basically your income statement. And then there's also, so you're mostly here to say statement of profit and loss and other comprehensive income. So this is where you have the top part will be your profit and loss, where you actually just show how much was your revenue, how much was your cost of sales, gross profit, and then you put in your normal expenses, either your salaries, your rent, which you need to pay, and then also you come to your net income. And then there's also just gonna be other comprehensive income, like if maybe you add something like your business involved in forex or something like that, which is actually not in the normal course of making and profit and loss. So we'll also just go through an example. So the statement of comprehensive incomes actually covers, like as I mentioned, a range of time. So you need to have a look. So sometimes it can say year to date, but if it says year to date, you need to know when is the financial year end. If, for example, the financial year end is December and you getting a financial income statement or statement comprehensive income return year to date 31 July, you need to know that that information is from January, is until the last financial year end to the last date which is written there. So it means it's for 7 months. If you get a statement of comprehensive income either saying for the year ended, just need to know that's for the whole year up to 30 June, or it can be for a quarter or 6 months. So it will just show you to see how much is revenue. So basically it's like your sales, how much is your cost of sales, your expenses, and after everything, how much is your net income. And if you've got shares, you just say, okay, how much did we earn per share for that company? So, and at the bottom is just say, okay, profit and loss. Did we make a profit or loss during this period? So that's why I say mostly has uses performance for 1 year. Mostly these financials actually required to be prepared at least once a year. So the statement of cash flows is actually just tells you, it just looks basically at the cash position. So the statement of comprehensive income, the statement of financial statement actually just looks at everything to say a transaction did happen. Whether cash actually changed hands, it's irrelevant. So with the statement of cash flows, it actually just to say it looks at how the cash, it only looks at the cash position. So actually need is basically to reconcile back to the cash balance. So at the bottom, the closing balance you have, it must reconcile to the cash you have in the bank. So it will start to say based on like your based on the nature of the business, how much cash did you actually generate and how much cash did you use to pay your debts. Maybe it's either you funded some activities. So it actually just complements your income statement as well as your balance sheet. So it shows everything to say your cash expenditures, your cash inflows, and from there on it can just see, okay, how is this company be able to make this to have money, and then also just to make sure it pays its liabilities and stuff. So there's three elements in a cash flow statement. So the cash flow from operating activities, so this is basically the information coming from your statement of comprehensive income. It just shows to say uh, from the sale of goods and maybe the payment of expenses, the main generating activity. So we sold goods of this much, we paid the expenses for this much. And from there on, there's also an element which focuses on the investing activities. So this is where, for example, you say, okay, we're buying, if maybe as a company is buying a vehicle, it needs to come to say, okay, we're actually buying a vehicle, and then how much, or maybe if we actually sold the vehicle, then how much cash did we get? So it's put it under investing activities. On financing activities, this is where we actually need to see how we actually have financed our business. So if we go and take out the loan, we're just going to say maybe proceeds from loans received. And then if maybe there's a loan which we actually needed to pay back, and then we'll also just show it there. So when you add these three elements, so the state cash from operating activities, cash flow from investing activities, as well as financing activities, you'll get movement for the year. And when you add that to the opening balance of your cash, you actually need to reconcile back to your closing balance, which will actually appear in your balance sheet. So if you have a look to say your cash flow statement is showing 500, but your balance sheet is actually showing 300, it means one of them is actually not showing correctly. But take into account when you look at your statement of financial position, you need to look at both the assets and liability sides, because other entities, instead of showing one amount, will show cash, maybe cash in the bank is 500 and come and say, but we own an overdraft of 200. So the net impact is actually 300. So there's also two further ones. So the statement of changes in equity, statement of changes here. So statement changes in equity or statement changes in capital. So it actually just tracks the total equity over time. So it ties back to the balance sheet, but only from the equity side of it. It just shows to say how much was the opening equity, how much retained income, basically profit did we make out of this, and if we paid dividends, how much did we pay in dividends? So it just shows, say, okay, as the owners of the business, what changed? Because the moment you generate profit and you actually put it in back in the business, it effectively becomes capital for the shareholders. And with the notes to the financial statements, it just actually just complements your information, which is you presented in the statement financial position, the statement of comprehensive income, your cash flow. So it just helps to understand to say if maybe you've got an item to say this is your property, plant and equipment. What do you mean by property, plant and equipment? What kind of plants do you have? If you say under assets, you've got investments. What did you invest in? Did you invest in shares? Did you maybe invest in other company? So I think that's what actually it shows in there. And also accounting policies, it just gives you an indication to say, what do we mean when we say revenue? For us, when we say revenue, this is what we mean. If we say there's a rental income, they will state there, okay, this relates to a property which is located, for example, in Senten, which we are renting for 500 a month, and then we're getting amount, and then how much are we paying for that expenses. And it will also just show breakdown, especially for some other items. Say, for example, your account receivables, your accounts payables, and then also if it's a company which is involved in, I find that this actually provides goods to other countries as well. It can say sales which are done in South Africa. These are sales which are done in Mozambique. And also for assets, you also need to show to say, we've got, this is how, if especially when you're doing the property, plant and equipment note, you need to show this was the opening balance. We've depreciated this by how much. This is what we feel is the remaining useful life for that asset. So I think here's just to show examples for like this financial position. So what we'll be doing through all those recording of transactions, identifying, this is basically where we're aiming to come to. So we're just going to show us to say whatever everything we do so that we understand how it's all going to look in the end. So this is just a picture, just a snapshot of a simple balance sheet, statement of financial position. So you will have your current assets, and then you have your non-current or fixed assets, and then here you'll have your total assets. So one thing with a balance sheet or statement of financial position, the total for your assets needs to equal to your liabilities as well as your shareholders' equity. So if you've got your liabilities here is long term, and then this is your current short term, which comes to 200, and then you've got your shareholders' equity, which is basically your common shares, which is when they actually started the business and put in as shares. So retained earnings is basically all the profit which they were putting back in the business as the years goes on. So if you have a look here, this is what I'm saying, you'll have cash, but for you to actually reconcile this to your cash flow statements, you actually need to come and check here. Do they have a bank overdraft? So they have cash, because cash is mostly cash and cash equivalents. So that meaning is like you can have money market, which actually, because it's short term, you can actually just get that. It actually qualifies as cash. And then there's also you find maybe it's cash on hand, where they actually have some bank notes, and bank overdrafts actually what they actually owe. And your account receivable, this is basically your debtors, to say, I've got people who are actually owe me 55,000. And then your inventory, this is basically to say, this is the stock which you actually have. So, and then you also have your prepaid expenses, where you find that actually people actually paid you like sort of in advance and stuff. And then on your fixed assets, mostly you're going to have your land, and then you'll have your vehicles, which are the vehicles you have as a company. What does your equipment? So sometimes you'll find mostly land and buildings, they'll be in one place, to say land and buildings, then it's added together. So this will give you your total assets. And on your current liabilities, so you will have to say, okay, this is your bank overdraft and your accounts payable. How much are you actually owing people? So your accrued expenses, basically, if it's when for example, you hired somebody to clean for you, and then you haven't actually paid that person, you haven't received the invoice for you to record it, but you actually know you actually own people. You need to actually recognize to see this is something which I actually owe is coming. And so if there's any tax paid as well. So for your current long-term debt, this is where you actually need to split out to see this current portion of the long-term debt is actually part of this, but this I need to pay 3.7 within the next 12 months, basically. So whatever portion is in the current portion, it needs to be paid within the next 12 months. The long-term portion is actually the other balance of it. And as mentioned before, you need to prepare your financials using comparatives to say a person needs to have a look at this to say, okay, last year it was 3, now it's 5. Is it improving or not improving? I see overall total assets have increased. What about liabilities and so forth? So same applies with the comparison for statement of comprehensive income. So this is where you say, okay, for revenue, it's either sometimes company will put revenue and then just put 205 and 175 and put note 1 here. This is where you need to go to your notes and say, okay, let me see the breakdown. Or most of this revenue is actually coming from lamps, or is it coming from fixtures? And the cost of goods sales is to say, okay, for this, when they were actually, what cost did they incur, which are direct to this revenue. So there's a direct labor, then there's also materials. The sales revenue less cost of sales, that's where you get your gross profit. And this is actually say, okay, what are your other operating expenses? Which other expenses did you incur, which sort of not direct? For example, you need to pay people salaries. It can be your office people. You need to advertise those goods, travel expenses, utilities. And then from there on, we can even split it further to say, okay, I need to see how much is it, say, before taking into account depreciation, interest, and amortization. And from there on, how much are your taxes? And then you will have your net income. So this is the net income where you see it's actually after tax. It goes basically to your statement of changes in equity, and then from there on, if there's dividends again, it will be shown in there. So on the statement of sorry, I go back on the statement of cash flows. This is basically where you'll see. So statement of cash flows, you'll see this, like it will depend. Actually, you've got options where you actually need to start it, but you just need to make sure that you actually put in your cash items. So here you actually show to say, because we started with net income, we need to add back depreciation because depreciation is not a cash item. So here we actually need to make sure that we only show cash items. So if there's anything like maybe we say, no, we amortized, or this is not cash, we actually need to add back to show. And changes in working capital, basically, this is where your working capital is your accounts receivable, accounts payable, so and also your stock. So this is where you actually check the movement to say if you've got, last year you had stock for 500, this year you've got stock for 300. So basically there's 200, which basically it means you basically sold. That's where you'll say, okay, there's a decrease, is actually an inflow to you. So you need to show to say from operating activities, how much did I do? From investing activities, like say, did you buy? So when you look at this company, they bought equipment in year 2, which was an outflow. So the brackets will be an outflow. They bought vehicles in year 1, which is also an outflow. And here's actually just to say they pay dividends from financing activities. So sometimes you can have a look with dividends. There's an option whether you put it under financing activities or you put it under operating activities. It's basically all of it is fine. It's just the choice option. And with the debt, you say, okay, they had debt, they decrease or increase their debt. So this company, they decreased their debt. If maybe they took out a further loan, it was going to be an increase. So this is when you add the effects of all this, you get an increase or decrease in cash equivalents. And this is the opening balance for your cash. And basically, this is the cash and cash equivalents at the end of the year. So this actually needs to tie back to your bank balance. That's when you'll see, okay, now my cash flow is fine, is balancing. And this is just an example of a statement of changes in equity. So basically, this one is just shows like starting from just those 3 years. But what it does is basically the same. So you'll have your items for statement of changes in equity, where's your common stock, and then you've got your earnings reinvested. So basically, this is your profit and loss you made for the year. And if there's any other comprehensive income you need to store. And then, so this is something cautious in health and treasury is just if maybe you've got your own, you basically have your own shows, and non-controlling if it's a big company. And there's maybe like 10% is actually not controlled directly. So from there on, you will start with the opening balance to say this is your stock, and then basically you say how much profit and loss did I make for the year, and how much dividends did I pay. So that's basically you actually reconciling to say at the end of the year you had around this is how much you had in statement of changes in equity. So this will be your total equity for the year. So if we look at same thing, so mostly companies, what they do, they like to present the last 2 years. So because of comparison, it will be like block to say we're starting December 2019, and then shows you what was the balance at December 2020, but we're actually coming back again to see what was the balance in 2021. So I think that's it based on this schedule for now. I'm not sure if there's any questions or if there's anything directly, and then in the next sessions we'll actually go into detail just to show how we actually record those transactions from when you have a transaction until it actually appears in your financials. Okay, I think that's it from my side. And then the next one, I think we'll just show the actual practical part of it, how we actually record the transaction, where we start. But this was mainly just to show the purpose where we're actually going, where we say, okay, this is a general journal, this is a trial balance, how it actually all gonna tie up. Yeah, bye.